Good morning, all of you.
Good morning, sir.
Good morning, sir.
Right, it's audible, all of you. Right, we have stopped. Yeah. Right, we will continue from this slide number 16. Um, right, need for valuation approach. So valuation, we know that valuation means we have to give a certain amount for a asset, for something. So rupee value in terms of dollar, in terms of pound, so whatsoever, we have to give some amount of value. So that is called valuation. So now we are dealing with financial assets like uh, ordinary shares, preference shares, bond, and debentures and other assets, financial assets. Right, we have to make valuation. Right, there are different models to value shares, especially financial assets, especially uh, ordinary shares. So in the last class discussion, we studied that the ultimate objectives of financial management is to maximize shareholders' wealth. That's the ultimate objective of shareholder, ultimate objective of financial management. So, maximizing shareholders' wealth. It means uh, the shareholders are invested on company shares. The shares are listed in the stock market. If the company performs well, it will it will give a positive impact on share prices. Say the company performs well, it means share price will be go up. If the company performs badly, and it will adversely impact on shareholders, the share price, right? Share price. So shareholders wealth maximization means shareholders all shareholders are expect that their price in the share market should be go up. So the shares are the assets of the shareholder. Shareholders are the owners, right? The managers of a firm should work on behalf of shareholders. Shareholders are expecting higher return, higher wealth, so represented by the share price. Okay. Shareholders wealth maximization requires a valuation model, right? So therefore, to evaluate the share price, there are many models to evaluate whether shareholders wealth maximize or not, increase or not. The financial manager must know, as a financial manager must know how much should a particular share be worth. The manager, apart from the market price of the manager, financial manager should know. So, what is the exact value of the share, right? So there are different types of prices, right? Market price and fair market price and book value, right? In string value. So there are different values, liquidable value. There are values. So if the share price in the market reflects the market price. The actual value of the share price, the share may be more than the market price or below the market price. So the manager, financial manager, should evaluate the exact value of that share. Upon what factors or factors should its value depends. And also the manager should understand. So due to what reasons the price, share price impacts, right? So the financial manager should know two things. First, so what is the exact value of the share and what are the factors impact on its price value. Now we will discuss about risk return trade-off. As a student of financial management, you have to have a very clear idea about risk return relationship, right? The risk mean the synonyms you can find as uncertainty, right? That is risk. Uncertainty mean we can't say exactly, right? If you make an investment on any business activities, for some business you can tell exactly how much profit you can make on that investment. There are some investment you can't say exactly how much you can earn as profit. It may be sometimes you can realize profit, sometimes you can realize loss. It's uncertainty. If you are not sure about how much return you are going to you are going to realize, that's uncertainty. That's risk. Say, for example, you have a certain amount of money. Say, um, right? Can you see the Excel sheet? All of you,
Yes, sir.
Yes, sir.
right? In the bank, right? You can deposit, say HNB. You deposit 1 million rupees. You invest 1 million rupees. It says the rate, interest rate is say 10%. Interest rate is 10%. Interest 10% is the principal amount investment. Right? Investment is 1 million and interest is 10%. Then how much? Uh, so you keep the deposit for 1 year, right? 1 year. How much you can realize as profit return on this investment? How much? How much you can realize as investment profit return on investment? So simply we can calculate 1 million into, yeah, 0.1 is 10%. So that is 100,000, right? So what about the certainty? Can you predict at year one, at the time of investment, is it possible to calculate, estimate the profit? Yes or no? Is it possible to estimate the profit in 1 year? In this case, is it possible? Yes or no? In the chat box, you can in the chat box you can mark if it is possible to estimate the profit at the time of investment. You put yes in the chat box, right? How many of you are replied? No one has replied. Yeah, only one person has replied. Yes, we can predict, right? Yeah, good, good. And right, this is option one, investment option one, right? Now we will move to option two. Option two, that is you give your money to one of your friends, right? One of your friend, his name is Nimal, right? He's a business person, and you put the same value of money investment, right? As a loan, you give this 1 million as loan to Mr. Nimal. Then, are you expecting the same interest rate received by HNB or a different rate? Same or different rate? My question is, at the time, you have two options. Option one, you can put your 1 million rupees into the bank HNB at interest rate of 10% for 1 year. Option two, Mr. Nimal is your one of your friends, and the same amount 1 million has you are given to him, right? You are given to him, and he promised that I will give interest, right? A certain percent of interest, right? So this interest um, equal to 10% or below 10% or more than 10% you are expecting. Below or more, please put your answer in comment box, chat box. Are you expecting same rate or different rate? If it is different, high or low? Below. Then other answers below. No, no, no. Actually, if you are a rational person, right, you are expecting the interest rate is more than 10%, right? Because uh, my question is, do you believe, right? Do you believe Mr. Nimal exactly give the interest or profit as he promised? So bank, yeah, if you put your money into the bank, yeah, bank has promised at end of 1 year, I will give you 100,000 as per the said interest rate 10% on that investment. But the Nimal, right, you are given the same amount. Do you believe, are you make sure, is it 100% sure that Mr. Nimal will give you the interest to you, profit or interest or profit? Is it 100% sure? Yes or no? Sure or not? No. Right. No. Only Sajid Edilshan has replied. Amarasri replied. Others, right. Pavitra also replied. 1 minute. Uh, right. So we can't say as he promised he can give that money. So therefore, so uncertainty, right? We can't make sure, no. So that's called uncertainty. Say for that uncertainty is called risk. To bear that risk, we are expecting higher return. Say for example, uh, if he asked money from me, I said 15%, because so I have two options now. So if I have 1 million, I can put that money into the bank and I can realize return as 100,000. It's 100% sure, right? 100% sure. But if I put that money, if I give that money to Mr. Nimal, the same amount. So if I also get the same amount, so why do I put my money to Mr. Nimal? It's a risk, you know. If I demanding 10%, if he gives, I can get the same 100,000, right? But it is not sure, no, not sure. It is not sure, isn't it? Not sure. So this not sure is called risk. This is uncertainty, right? And not sure means uncertainty, right? So therefore, right? So we have two options. So if I deposit money into the bank, I can get 10% interest, and if I give that money to Mr. Nimar, he also give 10%. So my option will be this one, option 1, right? Because the return are same. Return are same. Here, he also bank also will give me 100,000, and Nimar also will give me 100,000. But option 2 is risky, right? Risky for the same return, return this one 100,000, same return, but the risk is high. Risk is different, right? If Mr. Nimar promised to give 10%, so what's the best option? Option 1 or 2? Both of us promise to give us 10% interest, right? 10% interest. So what's your option? Option 1 or 2? Both of them are promised the same interest rate. So are you prefer option 1 or 2?
Option 1.
Option 1. Option 1, because we are getting same return but for the different risk, right? So we are getting high risk in the option 2. Therefore, Nimal promised, no, I will give you 15%. This time, so you can realize 150,000 as profit. 150,000 as profit, but still it's uncertainty, right? Still I'm not sure, right? You can realize this profit at the time of he give that money, right? If you put the money into the bank, you can exactly tell the date. Yeah, on this date I can withdraw my money with my profit. But if you give that money to your friend, you can't say, he may promise you, yeah, I will give you that money on 31st December 2020. But the real thing is, you realize at the time of at the time he has promised, right? But then he promised, I will give you 15%. This time, what will be your option? Option 1 or 2? You will go for option 1 or 2? Are you willing to put your money into bank, or are you going to willing to give money to Mr. Nimar? Option 1 or 2? Okay. Type the answer on the chat box. Now earlier he has given promise to give us 10%, but so due to high interest, now there's some negotiation, right? Some of Ishuru has told me option 2, and Pavitra option 2, right? Option 2, but the decision is not sure. Decision is not sure, right? We can't exactly say, right? Exactly say, right? Exactly say, because the person who is willing to take risk, he may choose option 2. The person who is not willing to, he is not like to take risk, he will go for option 1, right? So option 1 is low risk. Low risk. Option 2 is high risk, right? So the bank option 1 is sure, no risk, right? Option 1 is no risk. Option 2 is high risk, right? It's a risky portfolio, right? When you look at this return, right? This is return. This is return, right? This is return. So for low risk, if anybody is not willing to take risk, he may put their money into the bank and he will realize 100,000 rupees as a return. And if the person willing to choose option two, it means he is risk lover. He is ready to take risk. Then he will get 150,000, right? So we can find there's a relationship between low risk, low return, high risk, high return. Here the low return, no risk, low risk, and low return, and high risk. Here high risk, high return, high return, right? So option 3, right? Option 3, right? Uh, you buy a ticket, right? Ticket, author, right? And you buy a ticket, say, oh, yeah, you put the same 1 million. The value of the ticket is 1 million, right? Value of the ticket 1 million. If you win in the ticket, in the lottery, you will get 100 million, right? 100 million. If you lose, then you have to lose your all investment. This is option 3. So this time, which is best option? 1, 2, or 3, right? So there's a ticket called Lucky Today, Lucky Day, right? Lucky Day is the name of the ticket, right? Lottery, like Mahajana Sambata or Vasana Sambata or whatsoever. The value of one ticket is 1 million. If you win in that ticket, the lottery, you will get 100 million, right? Say, oh, 1 billion, right? 1 billion. If you win the lottery, you will get 1 billion. If you are lose in the ticket, you will all investment, right? This time, risk is high or low? Risk, highest risk, isn't it? Highest risk. So highest risk. Then here, totally unsure. Totally unsure. Therefore, he expect highest return. Highest return, right? When you compare option 3 and option 2, which is the best option? Option 1 or 2 or 3? When you compare option 3 and 2, yeah, option 2. But option 2 is best option for the risk averse, the person who is not willing to take risk. If the person want to become a richest person within 1 or 2 weeks, 1 or 2 days, so he may choose option 3, right? Option 3, highest risk. Therefore, it gives highest return, right? So this is the risk and return relationship. The final thing is, so low risk, low return, high risk, high return. But keep in your mind that you are taking high risk is not a guarantee to get a high return. But the highest return always be with high risk. Right? To get high return, you have to be a high risk. But if you are taking high risk, it means it's not a guarantee that you are getting highest return. Right? And right. Risk return trade-off. Financial decisions of the firm are guided by risk return trade-off, right? So if you are a financial manager, all the decisions are all the financial decisions are dealing with risk and return trade-off. Trade-off means balance, right? So balance. The return and risk relationship. Here, return equal risk-free rate plus risk premium. You have to have a clear idea on what is the risk-free rate. Risk-free rate means here in this example, option one. We go for option one. Is it risky or not? Option one. Please comment on chat box. Option one, putting money on HNB is risky or not? Yeah, it's not a risky. Yeah, so that's called risk-free rate. So HNB is give interest rate at 10%. That 10% is risk-free. We are not taking any risk, but we are getting some amount of return. So that is called the percent of return. That is called risk-free rate. The rate of return at no risk called risk-free rate, right? Risk-free rate. And risk premium. Risk premium means so we give a certain amount of money to your friend called Mr. Liman, right? And that's a risky investment. Risky investment. So he give us additional return 5%, right? Additional return 5%. So he has promised us to give 15% as interest, right? So we can divide that 15% into two parts. The first part is risk-free rate, another part is risk premium. The risk-free rate in this example 10%, risk premium is 5%. So total return is 15%, right? So risk-free rate is a compensation for time and risk premium for risk. Here you may ask a question. So we are not taking any risk in the when we are depositing money into the bank. So why do we get return? Because you are waiting. You are waiting for a period of time. You have sacrificed your money for a period of time. For that sacrifice, the bank give you the return. That is risk-free rate, right? You have paid for some period of time. Risk-free rate is a compensation for the time, and risk premium for risk. Yeah, when we look at this example, this picture, you may realize that here in this here expected return, and here vertical axis expected return and horizontal axis risk. So this is the time beat, right? When the risk increases, the return also increases, right? This is the return, right? So when risk increases, return also increases. That's why the line is upward sloping. And also notice that here start the return is not started from zero. It is started from here, this point. So this rate is called risk-free rate. Risk-free rate. In this example, so you are give that money for 1 year. So risk-free rate is 10%, right? Up to this rate is risk-free rate, and he gives us 15%. So this area 5% risk-free. This is what risk premium. This is risk-free return. So 10% plus 5% equal 15%. The risk and expected return move in tandem. The greater the risk, the greater the expected return. Now we see the overview of financial management. Financial management, the objective of financial management is maximizations of share value. Maximization of share value. It means whatever the decisions you are taking within the organization as a manager, all all decisions will reflect on the share price in the market, in the share market, right? If you perform well, if you manage well in the organization, the share price will be go up. If you perform badly, then the share price will go down. So as an efficient manager, all the times we have to focus on maximizing the value of share, right? To maximize the share value, the financial managers take decisions. It's called financial decisions. We can categorize all decisions taken by the organization. We can divide into four categories. We can categorize into four. Investment decisions. The first decision, investment decision, liquidity management, financing decisions, and the dividend decision. Right? Investment decisions mean, say, how it's about it's investment decisions dealing with um, long-term assets, property, plant, equipment, right? When you look at the balance sheet, you can observe long-term, like non-current assets, investment decisions, whether are we going to make new investment or not, whether to purchase machine one or machine two, or whether to produce product one or product two. So that kind of decisions for the purpose of making profit, all that kind of decisions are coming under investment decision. And liquidity decision, liquidity management, it's a working capital management, liquidity. So manager, as a financial manager, he should make sure that the organization have a sufficient amount of money to run the business in day-to-day basis. That's liquidity management. They should maintain the proper amount of current assets and current liabilities, and they have to take decisions how many days we have to give to settle the payment from the debtors, right? How many within how many days we have to settle our creditors. That kind of decisions, how much amount of inventory we have to keep, how much amount of money we have to keep in our hand. So that kind of decisions is called liquidity management. And financing decisions, where the finance manager is going to get the required amount of money to the company, right? Where is going to get the money. So that is called financing decisions. Under this financing decisions, they have to make decision like whether we are going to raise fund through equity shares or preference shares or bank loan or bond, right? So if we go for equity shares, how much? So how much we have to raise, right? That kind of decisions. And dividend decisions. So dividend decisions is about, say, a company have earned a certain amount of money, right, as a profit. This profit is belongs to the shareholders of the company. As a manager, you have to decide how much amount of dividend should be distributed as dividend to the shareholders, and how much amount of money should keep within the organization for the future investment. So that kind of decision is coming under the dividend decisions. So all these four financial decisions with the criteria of risk return trade-off, right? With the criteria of risk return trade-off. Now we will move to the agency problem. Agency problem. Agent principle, right? You know that shareholders are the real owners of the company. Shareholders are the real owners of the company. When we look at how many shareholders for many large organizations, it may be 1,000, 1,500, 10,000, 100,000. There are many owners for a single company. Therefore, it is very difficult in practical to manage the company by the shareholders, right? It's very difficult to take decisions to manage the company. So therefore, all the shareholders come together in an annual general meeting, and they are appoint a person, a representative, a person called manager. The manager is an agent, right? The manager should work out on behalf of the shareholders. Therefore, the shareholders are the principal, right? Shareholders are the principal. They're the owners. On behalf of the owners, the manager should work out his agent. In real world, right? In real world, the manager should work, the agent should work on behalf of the owner, principal, right? There is a principal agent. Principals are the shareholders, agent are the managers. Principal agent relationship between manager and shareholders. In theory, managers should act in the best interest of shareholders. It means the shareholders should work out on behalf betterment of the shareholders. In practice, right, in theory, managers should act in the best interest of shareholders, but in practice, managers may maximize their own wealth, right? Managers all the times try to maximize own wealth rather than maximizing shareholders' wealth, right? So if you are appointed as a manager for a company, what you expect? Do you think that I want to work hard for the betterment of the owner, or work hard for the betterment of yourself? Tell honestly. If you are appointed as a manager, what do you think? Are you work hard for the betterment of the company, or work hard for betterment of your wealth? Please tell your answer in the comment box. Company or yourself? Are you expecting high salary or high profit for the company owners? You are work hard, right? You have work hard in the company. All the profits go to the shareholders, the owner, but you are getting only small amount of salary. Are you expect high salary or not? You say the answer. My question is, are you expect high salary or not? Yeah, high salary. High salary mean that's the own wealth. Getting high salary means you are expecting to increase your own wealth, right? Your own wealth. That's a real situation in companies, right? If you are getting high salary, that time it will impact the profit. The profit is belongs to the shareholders, but salary is expense for the shareholders. when you are demanding high salary, it will increase the cost of the company. Finally, the profit will be go down, and the shareholders will be suffer. And then it will reflect on the share price, and share price will be go down. In practice, managers may maximize their own wealth in the form of high salaries and many packages. Right? They want luxurious car, right? Bungalows, right? Guest house, it's like a bungalows, and they want right, very luxury room, luxury office building, and they want very beautiful PA, personal assistant, personal secretaries. So they want a lot, right? So these are the expenses, right? For manager sides, they may argue, I work hard for the organization, then I enjoy. But the shareholders argument, we make investment, we have sacrificed our money for the business, we want more return, right? So there's a conflict between manager and the shareholders. This kind of problem is called agency problem between agent and principal. Agency problem, manager versus shareholders. Managers may pursue their role as reconciling conflicting objectives of shareholders. Conflicting objective means the managers all the time seeks to maximize their own wealth, but shareholders' point of view, they want to maximize their profit. These shareholders, the stakeholders' view of managers' role may compromise with the objectives of shareholders' wealth maximization, right? So anyhow, uh, shareholders are expecting high profit, and managers are expecting high salary. So that's a conflict. So finally, they have to compromise for the purpose of increasing share prices. They come to the negotiation and come to a certain point. Managers may avoid thinking high investment and financing risk that may otherwise be needed to maximize shareholders' wealth, right? So we will discuss in detail later, right? So there are investment opportunities. On that opportunities, they can maximize profit. Anyhow, managers are not willing to start that project, start that business because of their agency problem. They are not willing to take high risk. So there are problems you will discuss in detail in forthcoming chapters. Such satisfying behavior of managers will frustrate the objectives of uh, shareholders' wealth maximization as normative guide. This conflict is known as agency problem, and it results into agency cost, right? Agency cost. To resolve the problem between the manager and the shareholder, there are a lot of precautionary activities to be taken. So that activities will take cost, will incur cost, right? Then agency cost. Agency cost include the less than optimum share value for shareholders and cost incurred by them to monitor the actions of managers and control their behaviors. So normally in practical world, corporate world, how shareholders control managers, the answer simply is by auditing. By appointing auditors, board of auditors, appointing internal auditors, and corporate governance practices. These are the ways to minimize the agency problem, right? So audit charge, audit fees, corporate governance expenses, internal audit expenses, right? Reporting, uh, reporting requirements, everything may incur cost. This kind of cost incurs due to the agency problem. And financial goals and firms' mission and objectives. Firms' primary objective is maximizing the welfare of the owners, but in operational terms, they focus on the satisfying of its customers through the production of goods and services needed by them, right? So ultimate objectives of organizations to maximize profits, but nobody says we are going to make profit, but they are all the times they are saying customer satisfaction is our aim, the main objective. That I don't know how, to what extent their statement, this statement is true. So when I ask a question, right, why you are studying? So what is your ambition? What is your ambition? When I ask the question, what is your ambition? Hmm? So can you say something? What is your ambition in chat box? Why do you study hard? Why do you join the university? Type your answers. Type your answers. What's your ambition? Madhusanga, what's your ambition? That is, yeah, who says, Dilshan says, to get high salary, that's not an ambition, that's the ultimate objective, right? So I want to become a doctor, I want to become an accountant, I want to become a manager. Actually, that is the ambition, maybe, but the thing behind that ambition is money, right? If anybody says, I will give you 2 lakhs or 3 lakhs or 5 lakhs money, uh, you don't need to work. Are you happy or not? You find a job for what? To get salary. You want money. That's the thing. If you have a business opportunity, then you don't need to find a job. You can do the business. But the ultimate objective is the people need money. All of you are studying for the purpose of getting the job. The ultimate objective of getting the job is to get high salary, the wealthier life. Wealthier life. That is the thing. Likewise, the company says, so you says, I want to become a manager, accountant, right? There are many things. Likewise, companies are saying we have to satisfy our customer, we have to provide quality product. We are the number one in providing. We are the number one in giving hot news. We are the number one in producing the best products. So that kind of things they are telling. So that is a firm's mission and objectives, right? But the financial goals, maximizing profit, maximizing shareholders' wealth, right? That's why here it says firm's primary objective is maximizing the welfare of the owners. Right? Firm state their vision, mission, and values in broader terms. Wealth maximization is more appropriately a decision criteria rather than objective or a goal, right? If the company says customer satisfaction is the best, is the most important objective, then if customer asks that product in a lower price, then company most of the times, no, we don't want customer, we want money, profit, right? Goals or objectives are missions or basic purpose of firm's existence. The shareholders' wealth maximization is the second level criterion ensuring that the decisions meet the minimum standard of economic performance. So all the companies have some criteria. So the required rate of return, required rate of return. So at least uh, how much amount of profit we have to generate it through an investment venture. And in the final decision making, the judgment of management play a crucial role. All times they are considering the wealth maximization. The wealth maximization criterion would simply indicate whether an action is economically viable or not, right? If it's profitable, yeah, it's viable. If it's not profitable, it's not viable. Organization of the finance functions. Reason for placing the finance function in the hand of management. Financial decisions are crucial for the survival of the firm. Financial actions determine solvency of the firm. Centralization of finance functions can result in a number of economics to the firm. Like these are the examples for the organizational structure, especially for the finance function, right? Some organizations say finance manager, some organizations say the financial controller, CFO. So if you are appointed as a finance executive, so what your task is, uh, the exact organization structure for finance management will differ across firms. The financial officer may be known as financial manager in some organizations, while in other as the vice president of finance or the director of finance or the financial controller, right? So there are different positions in these positions differ organization to organization, right? In university system, the finance manager here called as bursa, right? In companies, accountant. Some companies, chief financial officer, right? In some companies, fund manager. So there are different names. So the role of treasurer and controller. Treasurer in Sri Lankan context, they have the different names. And also the role of treasurer and controller done by one officer. The two officers, the treasurer and the controller, may be appointed under the direct supervision of chief financial officer to assist him or her. The treasurer function is to raise and manage company's fund, while controller oversees whether the funds are correctly spent. So this is the uh, up to yeah. This is end of the session today. So any questions you can ask. You can ask any questions in chat box, or you can unmute your mic and you can ask questions. Anything to ask from this unit? Okay.